Good morning. My name is Lynn Gillette. I'm the president of the Silicon Valley chapter of the American Association of Individual Investors. We are having our November program on taxes, and we're lucky enough to have Claudia Hill as our presenter. I'm going to do a couple of housekeeping announcements, and then we'll start the program. Since we have a large group, we're going to be well over 50 or 60. The primary way of asking questions of the speaker will be through the chat. So just type your questions into chat and we will bring them up to Claudia. One thing I want to repeat, we're looking for additional volunteers to help us run the chapter. These can be positions of being on the board or just being a volunteer. We have a number of people that just volunteer, don't attend board meetings, but do very valuable work for us. So if you're interested in helping in this area or in publicity, in finding speakers and maintaining the Facebook page, do video editing and other areas, contact myself or any of the board members, and we'll be more than happy to have your additional help. Two quick announcements. Our January program is an economic forecast for 2022. Nick Atkinson is the presenter. He's from Delta Investing. He's done some very good presentations for us in the past, and we're delighted to have Nick coming and doing our, we used to do an annual forecast in January every year, but we've not been able to do that successfully as often as we'd like. And then that's on January 8th on a Saturday. And then on February 12th, which is the second Saturday in February, we have our income investing presentation. We have Harry Domesh presenting on dividends in general and income investing in general. And then he's going to do some specific work on how do you maximize fixed income, and he'll be dealing with preferred stocks and the way to do that. And then we have Andy Profit, a former board member for Silicon Valley who lives in Portland. He runs a special interest group in dividend stocks, does his own work, has nothing to sell, and is continually improving his techniques, and he does a good job. Okay, Claudia Hill is an enrolled agent, an MBA and principal at TaxMam Incorporated. Her subject is 2021 year-end tax planning and changes for the year ahead. Three quick bullet points just to frame what she'll be presenting is how to understand the real tax rates you pay, how 2021 income tax changes will affect you, and then the big question, the estate planning changes, including or proposed for 2021. Claudia has presented to us many times. She's one of our most popular speakers. She's an enrolled agent, nationally recognized tax professional, frequent lecturer on taxation and individuals, and representation before the IRS. She's editor of the Volkers Kluger publication, formerly called CCH, Journal of Tax Practices and Procedures, co-author of the CCH Expert Treatise, Tax Practice and Procedures, and a frequent presenter in both person and over audio links for CPE seminars nationwide. Claudia coordinates a dream team of tax controversy advisors for the IRS Watchdog blog on Forbes. She was named a top 10 nominee by tax analysts as 2011 Person of the Year. Claudia, we're delighted to have you back. There'll be a break that Claudia will coordinate in terms of when it's appropriate, and bring your questions to Claudia. And Claudia, you have the floor.
Thank you. Are you able to hear me well at this point?
I can hear you fine. I assume everybody else can.
Great. Okay. Then I want to share first that we're going to organize the materials today into 3 segments. And the 3 segments are going to be, first, we're going to do an update of changes for 2021, as well as the recent legislation, which who knows if they're going to be getting something else out before the end of the year, but we'll go over what small tax issues were included in that legislation that passed a week or so ago. Then the middle section we're going to do is related to retirement plan distributions, because the Secure Act made a number of changes to how our money, how long the money can stay in the retirement accounts, who can be the beneficiaries, and the R&D rules. So we're going to do a small segment on that in the middle. And finally, we're going to do year-end planning techniques. Now, I will, if I'm sure you have a little chat thing, so someone will be monitoring questions, and I'm going to stop now and then and say, are there any questions that someone wants to read to me about that people have sent in, so that we can go from there. Okay, if we are set, then we will go to things that have changed for 2021. The standard deduction. And I want to make some observations first about the standard deduction, because we've had these high standard deductions for the last couple of years since the Tax Cuts and Jobs Act. And they were fairly dramatic. They were more than double what they used to be. And a lot of us are still struggling with, is there a way to get maximum benefit out of these very high standard deductions? So some of the pieces we're going to talk about today is strategizing on how to make the best advantage of the high standard deductions. And my goodness, for a single filer, if you are over 65, you don't have tax until you hit $14,250, unless you have other types of taxes. And what I mean by that is it's all income tax, but our government has found a way to nudge and prod and squeeze a little more blood out of a turnip, I guess, by creating add-ons to taxes. And that's part of what we see when we see someone whose income is under these thresholds, yet they're still paying a net investment income tax or other variations on things. So the standard deduction for a single person under 65, $12,550 this year. Filing jointly, it's $25,100. Now filing separately, look at that. The standard deduction is only $5, okay? Which is weird, but when it comes right down to it, it's not necessarily. The issue with married filing jointly and separately is you have to be consistent with how you file. If you file separately, if one person files itemized, the other person has to file itemized too. Okay, so we will put these numbers in our head. Gee whiz, as a married filing joint return under 65, my standard deduction is $25,100. So I don't pay any tax generally if my income is not over $25,100. Well, part of the way they got to this was eliminating your exemptions, you know, and the standard deduction used to be much lower, but we also had personal exemptions. Those are gone. It's now all wrapped into this one number. Okay. So I've also included here the rate schedules for single individuals, and we can see on this that for a single individual, 9950. When someone talks to you and says, what's your tax bracket? What they are referring to, I'm going to try to get it over here, is this part here on the very far, in the middle of the second column here, where it says percentages, okay, at the top header. When someone says, what's your tax bracket? If you say you're in the 37% tax bracket as a single person, you're saying that your income is in excess of $523,600. That's what the tax bracket means. Now, does that mean you pay taxes 37% on the entire 523? Absolutely not. That's your cumulative. And you can see how this cumulative grows. And so you have a incremental rate at the very top pieces of income. And then you have an effective rate, which is really of the total money that I've got coming in. What's the total tax I'm paying? Where you simply divide the total tax by the total income. Okay, so distinguish between those things when you think about what your tax bracket is. Okay. The joint filers, you can see that there's still a marriage penalty, because a moment ago when we looked at the single filers, the 37% started at 500 and something. Joint filers, that 37% starts at 628. So the higher your income is, okay, the more, well, you hit a piece in there where, gee, do I really want to be married? But of course, we don't get married for taxes, do we? So, but that's part of the thought process when you look at how weighted our tax system is, with variations on rates based on whether you are married or single, and variations on positions that can be taken even. For example, the passive activity rules on restricting rental losses have thresholds built into them that cause married people to pay more in tax than the single by comparison. So the tax system is somewhat flawed, but I think all of us would agree we live with it. Now, one thing I want you to also think about is the tax rate on estates and trust. And I'm going to put this and try to distinguish it a little bit for you, because you hear a lot of comparisons about, well, what if I have a trust? Am I going to pay more taxes? Probably not. But here's what the debate is all about. If you have a trust, and if it is not a grantor trust, and if income is retained in the trust, all those ifs, okay? If income is retained in the trust and not distributed out, the message that you're hearing is that trusts pay the highest tax rates. And that's because that 37% bracket begins at $13,050, okay? $13,050, that's not very much, okay? So when someone says, well, it's not fair because trusts have to pay such a high amount of tax, well, the government's sending you a message here. They're saying, don't retain lots of income inside trusts. If you have a choice, get it out to individuals who will spend that money and help the economy by spending it, and probably pay a lower tax rate. When it comes to capital gains rates inside trusts, because the primary income inside trusts is qualified dividends, regular dividends, other types of investment income, and long-term capital gains. When it comes to trust rates as applicable to capital gains, they have the same 20% plus 3.8 net investment income tax that individuals do, but inside a trust, that rate starts, that 20.38% starts at the $13,050, not the 200 or the 400 that you see with individuals. It starts way down at 1305. Again, sending that message, do you really want to retain income inside trusts and pay taxes at the trust rate? When you have qualified dividends, that's what QDCG, qualified dividends and capital gains income. In addition to the tax rates we've just seen, you can pay a net investment income tax if your total income goes through certain thresholds. As I mentioned a moment ago, for a single person, it's the 200,000. On the trust, it was the 13,000 figure. Okay. And married filing jointly, that 3.8% starts at 250,000. This you can think of as a marriage penalty, right? Because 250 is not twice 200 when this 3.8% starts. So what does it really mean that we have a net investment income tax on those qualified dividends and capital gains? Well, if you have $220,000 taxable income and you have 200,000 that is wages and 20,000 that's qualified dividends, this extra 3.8 only applies to the 20,000 that is in excess of the 200 threshold. Okay. If you're living on capital gains and you have that same 220,000, and the vast majority of it is capital gains and qualified dividends and not wage income, then you still, on the first 200,000, are not going to pay a net investment income. You're not going to have the 3.8 extra added. You will only have it on the excess over that amount. Okay. If your income is over that amount and there's no qualified dividends and no capital gains, then you're not having to pay the 3.8%. But a heads up, in the legislation that is being reviewed currently, that not the one that has passed, the one that hasn't passed yet, an income, funding mechanism, a way of bringing some money in, is to apply this 3.8% against pass-through income that is not subject to self-employment tax. That's one of the proposals that's on the table right now that they're looking at in terms of how do we pay for the Build Back Better package that's moving through Congress. So that could affect those people who invest in partnerships and S corps who are not having to pay self-employment tax on their distributions, okay? Because if those distributions are taxable, there's no self-employment tax, then they're going to try to rope it into the net investment income tax and also apply it on those. Okay, so that'll be one to watch for. Now here's something that was in the tax bill that just passed. And I want to call your attention to it because it's constantly hitting the news. And I know I am constantly shocked by the values that are assigned to different cryptocurrencies. But the infrastructure bill, the one that did pass, is imposing new crypto asset information reporting requirements on brokers. It's in a new section 6045. Well, we've had information requirements on brokers previously. Think of this, it was passed in 2008, started becoming effective in 2011. And nowadays we take these broker required information reporting really very commonplace. What it's referring to is when you get your 1099 DIV or INT or 1099B for brokers, there's a whole lot more information than there used to be. For example, when you sell a security, if it was purchased after a specific date, they're required to say, here's what they paid for it, here's what they sold it for, okay? And this enhanced information to IRS is assisting IRS in finding people who previously were not necessarily reporting the full amount of their gains or who were forgetting to report their capital gains. So we've gotten familiar with that happening from several years ago, and IRS says, well, we're getting better compliance now because people are more forced to report their income they're earning from these type of transactions. So that similar type of broker enforced reporting of transfers of digital assets on behalf of another person will become part of the systems for those entities that act as the middlemen who do facilitate the transfer of cryptographically secured lecture information. Oh my goodness. This legislation is going to require brokers to provide that information reporting of any transfers to accounts that are not maintained by a broker. Okay, it should be interesting to see how IRS enforces this, but this is giving them the go-ahead to go ahead and do it. Okay, about 2 years ago, IRS sent out a notice to a number of people because they had served John Doe summonses and got information with names about who was transacting financial transactions using cryptocurrency. And the John Doe summonses were very effective. So IRS had thousands and thousands of names. So they sent a notice out to taxpayers saying, we saw your name on the list and we thought you might need to become familiar with what the reporting requirements are on cryptocurrency. And basically the requirements are that you have to report it just like anything else. So we're going to have a little bit more comments on that in a few moments, but be aware that there is a requirement in the bill that just passed that is going to require third-party reporting on crypto transactions. Okay. One of the other things that the latest tax bill did was expand the child tax credit for the 2021 year. Now, the there's so many family benefits that are in the law. There's the earned income credit, that's for lower income people. There's the child tax credit, and that child tax credit starts phasing out at 75,000 for singles, 150 for married couples. It starts being seriously reduced at 200,000 for singles and 400,000 for couples. So all the way up, and that does capture, when they get up to 400,000 for couples, they are capturing people that live where we live too, because we're one of the most costly places to live in the country. And when you think about it, tax laws at the federal level are made for states where there would be very few people earning 400,000 in some of these states. Yeah. Anyway, and we get our 2 votes in the Senate, and we get our House of Representative votes, but there are, unfortunately, a lot of provisions in the tax law that, in my opinion, should be rated based on the cost of living where you live, and not the great equalizing, here's what the national average is. Anyway, the child tax credit was amped up so that you don't lose it completely until you get a little over $400,000. But instead of being 200, it's 3,000 for most children, okay? And it's fully refundable. It counts as a tax against the tax that you're paying. And if it exceeds the amount of tax you have, fully refundable. Now, this 300 goes to 3,600 if your child is 5 years old and younger. Okay, so at age 6, you flip to the 3,000. At 5 and under, you're at 3,600. You may have heard that this last year, well, the current year we're in, okay, starting in July of this year, our government started handing out advance payments of this credit, and based on the age of your child, on the tax returns that you filed for the year 2020, the government said this person is likely to qualify, and they started sending checks out on a monthly basis. So, for example, you would get 3 times 6 months, 1,800 if you had a baby, okay, and qualified within this range. And then the other side of it, the other 6 months of it, you will get when you file your tax return for the year 2021. Can you guess that IRS may run into a few problems with sending money to people who aren't entitled to it? Yeah, that's going to be a fun one when people are asked to pay back this money that they got that they weren't entitled to. It's going to be yeah, just like the rebates were, the economic stimulus payments were. Send the money out first, then ask if you qualify later. Okay. Let's see. One of the other treatments in the child tax credit that had always been a strange one to me is that the child tax credit used to stop when your child reached 17. Most 17-year-olds are still in high school and still living at home and eating more than they've ever eaten, which means costing their parents more than they've cost them the previous 17 years, and the credit wasn't available. This year, for the year 2021, a 17-year-old dependent will qualify for that $3,000 credit. So this should be helpful to families. I mean, and a lot of focus from this bill is on families. A little bit more about that qualifying child tax credit. Let's see, who qualifies for it? You must be a US citizen, have a social security number, be claimed as a dependent. The person needs to be claimed as dependent on your return, under 18, and be a relationship with the parents, meaning the people filing the tax return, meaning it could be their son, daughter, child, stepchild, brother, sister, niece, nephew, okay, or an adopted child. Let's see. Another family benefit that was included in the tax bill that just passed is an increase in the amount of the dependent care credit. Okay, so it applies for a dependent child under age 13 when the care is provided, or a qualifying disabled dependent or a spouse of any age that lived with you. If you are having to care for a spouse who is currently disabled, okay, living in your home, okay, or yeah, then if you're paying for care in the home, and the care in the home includes someone coming in making their meals, as well as someone caring for them, did you realize that you could take a dependent care credit on that? It's not a child credit, but it's a dependent care credit with similar benefits. But you look at it and say, well, there's only one of us working, and in a child dependent care arrangement, if it's a joint return, there's two people working. And when you have the dependent, you're given a phantom number to use for the income of the dependent spouse who's not able to work. So dependent care has been increased. The credit itself has been, depending on your income, can be up to $8,000, and it can be up to $16,000 if you have more than one child. And it's the full higher amount. It's an income phase out. So it applies to all families, but if you're making between 125 and 438, you're going to receive at least a partial credit of the expanded amounts of the child tax credit, dependent care credit. Let's see. You've probably already received letters from IRS or struggled when you prepared last year's tax return about the rebate recovery credit. The rebate recovery credit was for those people who did not get the correct amount of the economic stimulus payments. Well, it was a horrible ordeal for the filing season 2020 because IRS didn't make it easy for people to remember what they got. And I tell you, I had a number of clients who swore to me, no, they didn't give me any money. And so we took a rebate recovery credit on the 2020 return. IRS has sent out millions of letters to people telling them that the amount that they took wasn't correct, that they weren't entitled to it, adjusting their overpayments applied from the prior year to the next year, sending them a bill because they gave it to them early, all of these things. But there were 3 total economic stimulus payments that went out. 2 were effective for the year 2020, but there's another one that is effective for the year 2021. And that was the round 3 stimulus checks that were $1,400 per person. That money came out, I think it was close to March and April of this year. If you missed out because your income in 2020 was too high and they didn't send you the $1,400, then you try again when you file your 2021 return, and we call it a rebate recovery credit. Hopefully IRS is going to send out letters this year telling people how much they received. And they say, why should we have to send out letters which cost us money? How about you go online and check and find out how much we sent you if you forgot to write it down? So I fear that unless we get some kind of notice in advance, the number of people who were affected this year are going to be beating their head into the wall again. Hopefully IRS will send something to remind you. I had clients who got these letters and they said, why did they do this to me? The amount you said I was going to get back, I didn't get back. One woman absolutely swore to me she did not get one of these checks. And you know what it's like to try to call IRS and say, and actually get them to pick up the phone and talk to you. Well, in one situation, I was able to get through. And when I finally talked to a person at IRS, not only did they tell me, this is how much your client received, this is the day she got it, here's how we delivered it to her. They had actually stuck it in her bank account, direct deposit, because they knew her bank account number because she gets Social Security. So I asked her to go back to her bank statement, look for that particular date, and oh my goodness, the money was sitting there. She was so embarrassed because she hadn't noticed, but that she wasn't alone. That happened to millions of people who didn't notice. So recovery rebate, we'll deal with it one more filing season. 2021 will be another year of try to get it right. There's another lot of confusion this last year with unemployment benefits. First it was, then it wasn't, then the quirk that affected community property states. So for 2020, $10,200 of unemployment compensation, and that could be up to $20,400 for married couples, was exempt from federal income tax for households with an adjusted gross income less than 150. Why was this a crazy maker? Well, first of all, that wasn't the law when we started the tax year and the tax forms were created for everybody. Early in calendar 2021, the government made it the rule, okay, that you could exempt it because it's a number part of the stimulus package that came through. Shortly after they said, okay, it's 10,200, the question came up, well, is that 10,200 per return, or is it 10,200 per person? Do married couples get the 20,400? The government's position on that was that, well, if you're married, the 10,200 applies to per return, which gave a lot of people in California a pause as to whether or not they should, if their income was under the 150,000, file married filing separately so that they could both exclude their 10,200. And it was a money saver. When did we figure all of this stuff out? Oh, probably about March. And millions of tax returns had already been filed by the time the government blessed this approach. So IRS even announced this last week that they had sent out another 400 and some odd thousand checks to people where IRS said, please don't amend your return, we'll correct them for you. Yeah, a lot of people were a little skeptical about IRS correcting them for them, but IRS is saying we're still working on it. We've got thousands to go, but that they will get back to you. So don't amend your return, even though these rules change mid-filing season, that they hope to get back to you. In fact, this last week, the National Taxpayer Advocate said that their office would stop intervening since IRS seems to be moving this along a little bit faster. It's a one-year problem because for 2021, Uncle Sam will once again fully tax unemployment compensation. Now, what does that present for people? Unemployment compensation, unless you intentionally check a little box, is not subject to withholding on those payments. Yeah, so you can picture what happens. A lot of people who draw unemployment, and this will happen for people in 2021, who draw unemployment will not have withholding on that $10,200 or how much they receive. And if that's the case, they're probably going to owe the government money. Yeah, well, at least it's a federal problem only because California does not tax unemployment comp. So federal problem only. Back to the old rule since 2021, the 10,200 one time, you don't have to pay taxes on it. It was a one time. Let's go to something that was also different last year and this year. Similar kind of rationale for what happened. For this should be 2020 up here where it says 202. We're not that far back. For a person who took the standard deduction, they were allowed a $300 charitable contribution above the line, meaning that in addition to the standard deduction, they could take the 300 if they made a cash contribution, cash or check only. If you are not taking the standard deduction, if you are itemizing, then you put all of your itemized deductions on your Schedule A. And so you weren't dealing with this little $300 piece. I had people say, well, I donate to the Goodwill. Is that going to count? No. Okay, 300. Can I put it in my donor advised fund? No, it has to go directly to a charity, and it was 300 per return. For 2021, the one deduction allowed per person, which means that married couples can, on their 2021 return, take $600. So they interpreted it differently coming into the year 2021. And this year, if you take the standard deduction, file a married filing joint return, you'll be able to take up to $600 instead of being limited to the 300. If you do itemize, I can tell you the fastest growing expense that I see among clients where they don't think they're going to have enough to itemize, and then it turns out they do, comes to medical expenses. So don't overlook these when you're trying to say, have I got enough expenses to beat this 20 some odd thousand that's a standard deduction for you. First of all, a lot of people overlook their long-term care insurance. It is a medical expense, and the long-term care insurance is age sensitive in terms of the total that can be deducted. So there are some parameters that might limit what you can deduct, but it is considered a medical expense and medical insurance. You know, your Medicare B, C, and D premiums are a medical expense. And you know, Medicare premiums, we're going to talk about this at the very end, are income sensitive. So you may not even think about itemizing, but if you get stuck 1 year in a high Medicare premium situation, then that could put you over the top with your total medical expenses, getting them enough to itemize, as well as break through the standard deduction. Let's see. So the two things that I mentioned here, the long-term care insurance and the Medicare premiums, if you are self-employed, don't overlook the fact that self-employed people, when they have a plan set up for the owner employee and all other employees, can deduct these two, the long-term care and the Medicare BCD premiums, as an adjustment to income. So that applies for the self-employed people on there. Don't overlook these when you're adding that up. House modifications, personal medical supplies, assisted living expenses, household medical attendance are all medical deductions. And these are ones that are sometimes overlooked. When it comes to house modifications, those grab bars and showers, those count as a medical modification because they're meant to protect your safety. Don't overlook these. Now, there had been some talk about the 7.5% AGI threshold for medical expenses going up to 10. At the last minute last year, they yanked that back and said, bring it back to the 7.5. Okay. But this year they have also made it permanent. So it'll be 7.5 of AGI and available to those that qualify there. So don't overlook those medical expenses. They can really, really add up. It appalls me that by the time we pay a supplement, the Medicare premiums and long-term care premiums, we are paying more insurance at the ages of 65 and over than we've paid in our entire life. Yeah, and hopefully you're healthy, so it's not a problem. Let's go to another change for the year 2021. And some of you remember what we used to refer to as the 3 martini lunch. Years ago, there was a bill that was put in to say, we're not going to let businesses keep deducting those 3 martini lunches. But in the tax act that passed because of the COVID incidents as an incentive to restaurants, and we all know that part of the issue was keeping our favorite restaurants alive during the pandemic, the law was changed for 2021 and 2022 to allow an increase from a 50% of a total business meals deduction to 100%. Now, that can be a fairly significant expense for self-employed individuals. And when I say 50 to 100%, the rule in the past was whatever you spent on that business meal, okay, whether you had one other person you were entertaining or 10 other people that you were entertaining, the limitation was 50% of the cost of that qualified business meal. Okay. For 2021 and 2022, it's 100% of it. So yes, your meal can now count too when you're doing that business entertaining. I want to get back to virtual currency for just a moment too, because a reminder that virtual currency transactions are taxable just like in transactions in any other property. And taxpayers who do transact this may have to report the transactions on their tax returns. In fact, the government has been trying to get people to be sensitized to the fact that they are asking you to say yes or no. Okay, so on the header to the tax return, and this is the basic 1040 for 2021, okay, right underneath your name and address information, there's the question, at any time during 2021, did you receive, sell, exchange, or otherwise dispose of any financial interest in any virtual currency? They aren't counting your Pokemon coins as, yeah. as a virtual currency for this point. It's ones that can give you monetary gain and benefit. But there is a difference this year between the question that's being asked and what it was last year. On the screen right below the primary shot of 2021, I have the question that was on the 2020 returns. And notice the difference in the question. Last year it says, did you receive, sell, exchange, or otherwise acquire any financial interest in virtual currency? And this year they've changed it to dispose of. Why dispose of? Because our government is treating virtual currency as if it is a capital asset. When do you recognize gain when you have a capital asset? It's not when you buy it, it's when you sell it. So they're using the phrase dispose of financial interest. This is much more complex than you would imagine when it comes to calculating income that is required to be reported from your virtual currency. If you were simply investing in it and selling it, it's straightforward. You can think of it as any other financial transaction. But if you are using it to transact business, to pay someone for their services, the fact that you're using it to pay for that services, the government treats as a capital transaction. And you recognize income on the difference between what you paid for it and what value it was used for at the time that you transact the business. This is, if it sounds like it's going to be a can of worms, it already is. Okay. But even last year, we started seeing some of the companies that are acting as middle people on these, middlemen on it, providing information so that it could be put into the tax return to calculate the gain and losses on it. So it's one that IRS is hoping to trap, I'm not going to say entrap, that's a bad word to use when we're talking about this. But if you think back about 12, I think it was 12 to 15 years, IRS did a really big deal about people not checking the box or accidentally forgetting to check the box that said they had foreign bank accounts. And IRS took the position that because they had not checked the box at the bottom of the Schedule B, that they had failed to disclose, and that failure was intentional on their part, and they could go for higher penalties and sanctions against them if they had inadvertently omitted reporting their foreign income. Okay, so the question here is, if you don't answer this question correctly on the return, do you risk the same kind of retribution that IRS brought down on people with foreign bank accounts? And that's been a concern to those of us who work with taxpayers and prepare returns. So just a heads up on that. Be aware that the question is there, and be aware that the posing of the question is part of a complete tax return. IRS can sometimes take the position that you failed to file a complete return, and they can say, because it wasn't a complete return, the statute of limitations doesn't start. You don't want any of those things. So attention to this box on the face of the 1040, and make sure that you have come up with a system to track any virtual currency investments. These are deductible until the end of 2021. We've had things that we called extenders. Okay, for many, many years, we've had tax bills that would pop in at the very end of the year and say, aha, we saved the extenders. Well, 2 years ago, the government said, maybe we don't need to save all these extenders. And they cut the list practically in half. But we still have some that were on the 2020 return that have until the end of 2021 to see if the government's going to keep them in the law. Mortgage insurance premium deduction, which is treated as interest on Schedule A if you are itemizing. That's okay on your 2021 return. At this point, we can't say that it's going to be on the 22. The non-business energy property credits, the ones for the skylights, exterior doors, insulation, those are okay on the 2021, but it's off there on the 2022. And this is a very nominal credit. It's not a huge amount on that one. The alternate fuel vehicle refueling property, if any of you have an electric vehicle and you bought one of those devices that you install in your garage so that you can plug your cars in at home, okay, that's an alternate fuel vehicle refueling property. That falls off at the end of this year. And the rate for residential energy property for electric has been extended through 22, and that's the 26% rate for those. It used to be 30. Remember, it used to be 30 on the electric, on the solar panels and stuff. It's down at 26. Okay, Build Back Better. Build Back Better as of October 21st. Here's the things that came through on that piece of legislation. Ordinary income taxpayers, for tax rates for taxpayers, you're not going to see an increase. You know, if your income is below 10 million. So I'm going to assume, all of us today have income below 10 million on an annual basis. And both ordinary and capital gains rates will not be changed. And what I'm referring to, I can be very specific on this, is the bill that passed a few weeks ago. This is the provisions in it. It didn't have a lot of tax changes in it. Okay? But the one that hasn't passed yet, that's still being negotiated, we'll talk towards the end, if we can, a little bit about what kind of tax provisions could be in that one. One of the things that was also on the chopping block that did not happen was the change to that 20% qualified business income deduction. And many of you know through your investments that 20% qualified business deduction is not limited to people who have Schedule C, Schedule F businesses, okay, or Schedule E businesses for the rentals. It includes REIT, Real Estate Investment Trust, dividends in that, as qualified business income. So a number of people are getting a 20% haircut on the dividends that come from the REITs. Now, there's also provision that you can get the 20% on your publicly traded partnerships, but reality is it's rare to see a publicly traded partnership that has taxable income. So you often will not see a QBI related to the PTPs. But believe it or not, when you get the sting on the sale of the publicly traded partnerships, that phantom income that you have to report because you sold it, that phantom income is subject to the QBI, and you get a 20% deduction on that. So lots of quirks on this, but there will be no changes for the 2021 tax year related to the QBI. There was no change to carried interest rules. The carried interest rules are the ones that was for people who put together funds, often funds of funds, and they take their commission and their interest in it. Their compensation comes from putting together that fund in the first place. Well, they get a share of it, a piece of it at the end. And in the past, they were able to say, yeah, I don't have to pay ordinary income on it. I'll get all at capital gains. The carried interest rules, in my opinion, were not anywhere near as fair as they could have been, but they had said, well, to get the long-term break on this, you have to hold them 3 years instead of 1 year. Not a lot of changes. There was no changes on that rule. So they really weren't addressed. And there was no change to the C corporation tax rates, which means I believe they're still at a flat 21. Okay. So none of that happened. And I'm not going to say you're home free all the way on this because we don't know what's going to happen in the next bill that comes through. So a few more things that didn't happen on that. There was a lot of speculation that the estate exemption was going to drop from the 11,700,000 per person that the estate exemption is at right now. It was going to drop down to maybe 5 or 6 million. Okay, that was not included in the bill. How long is it going to last? We don't know. Okay, but as of today, a big sigh of relief on that piece. There was also proposals that were floating around as this bill was coming together that would change the step up and basis rules or the deemed realization rules of the death for a state, saying that if you had appreciated securities that you were going to have to, instead of getting a step up to date of death value, which is like a golden ring to help make up for the person's death, they were going to eliminate that beautiful benefit, and that hasn't happened yet. Okay. So no unrealized appreciation, annual taxation of unrealized appreciation. I mean, come on, how do they administer something like that kind of a rule? And there was no change to the grantor trust rules. A number of my clients who have grantor trust were saying, oh my goodness, do I need to get out of the grantor status immediately? Do I need to step back from this? No change to those rules either. So you were home free on that. And there was no change to valuation discounts. A lot of people who do estate planning sometimes put their assets that they're gifting away into a trust or another type of entity, could be an LLC, a partnership. And in doing so, they put strings and attachments to it to make it less liquid. And the benefit of doing that is that they are able to discount the value of the assets transferred. That was not dealt with on that legislation. So if you are a person who was worried about having to do massive estate planning before the end of the year, Build Back Better, it was without any of these provisions. So it begs the question, how are they going to fund this next round of tax changes that are coming up? One of the things that was in the bill was a 400 billion budget, and that's not a huge amount because IRS budget is huge, but enhanced IRS enforcement. IRS, when they are enforcing the law, when they are being the cops on the beat and the ones that are noting the fact that some people haven't bothered to pay their tax returns or file them for several years, when they are given the opportunity to expand and work and do their job, okay, they bring in more money than they are budgeted. And so they are a revenue enhancer when it comes to funding bills. And this one did have, begs the question about, are they going to get that $400 billion enhancement to their budget so that they can bring in additional revenue to help pay for the bill? Okay. One of the other things about that they're speculating how they're going to fund it would be new tax rates for, I'm going to call them upper income taxpayers. They expect that to bring in $650 billion. It would be applicable on the top 0.02, okay, 0.02%, which means it's 0.0002 of the taxpayers. And what amazed me is at the very tip top percentages that they were looking at, it was only, they knew how many people were going to be affected. It was only 200 and some odd thousand people would be affected. Well, I'm not saying that, I'm saying, well, how fortunate that these people are able to earn this money. But what does it say about a tax system that says we're going to pick off only the top 0.02% of people and make them pay more when it comes? Anyway, I get very mixed about that. Also, they were looking at applying these same rules to non-grantor trusts that keep within them more than 500,000 of taxable income. But we saw at the very beginning that in those situations, those trusts are paying a much higher rate than normal anyway, because the 37% plus the 20% plus 3.8 was already kicking in way down at $13,000. So they were going to add another piece on top of it. And finally, one of the other ones they were looking at is, should they change the corporate international tax proposals? Because that could bring in billions of dollars too. Lots of issues, but anytime they work on a tax bill, they've got to look at how are they going to pay for it? And that these become pieces that can affect all of us. Now, one of the pieces that we believe is likely to come through is limiting the benefit of qualified small business stock. Currently, stock held over 5 years pays 0 in capital gains on the federal return. And actually, it depends on when you bought it, because there's 3 different time frames that affect how much of that QSBS gain is excluded. Years ago, it was 50% could be the maximum that was excluded. And then for a few years, it went to a 75% could be excluded, followed by 100% excluded. And that's where we are for stock that was purchased in the most recent 5 years looking back. A change to the exclusion here would apply to all trusts and estates and individuals with taxpayers with over 400,000 of gain. I mean, you think 400,000 of gain sounds like a lot, but per stock holding where a person qualifies for QSBS, that exclusion can be up to $10 million. So the 400,000 starts looking a little smaller when you think of people actually getting and exhausting their $10 million of gain and paying no tax at all. Okay, one of the other provisions on it is that they were looking at expanding the net investment income. That's the 3.8 that I've referred to several times, to cover pass-through income not covered by FICA or self-employed tax. And FICA is Social Security versus self-employment tax, which is what self-employed people pay equivalent to the Social Security. So they would be looking at expanding that as part of the 3.8% net investment income surtax. So these are all pieces that might be used to help fund the package that is next coming out. And every day you hear people fussing and fighting about stuff. And you know, I've gotten to the point where it's not over till it's over. Okay? You can sit there and you can get excited and upset every day about what's coming across in the news about the tax changes and the proposals and stuff. But it's not going to be what affects the reality of our situation until it gets to the end of this long journey. And it's not finished until it's passed both houses and the president signs the bill. Okay. So more begging the question about how they're going to fund it. Would they really increase the SALT limitation? Now, this is one that is not something that would bring in revenue. It's one that would release revenue. And this is one that affects, California is one of the top 5 states that are affected by this. But this provision is still being fought about even this morning, because I checked what was still, what's in, what's out this morning before we started the section. And the issue is, how much will they increase the SALT limitation? Currently, the SALT is state and local taxes. State and local taxes for people who live in California, if it includes your property taxes on your home, your California income taxes, your personal property taxes. These are the primary state and local taxes. Most employees or any person buying a house nowadays is going to have more than $10,000 in state and local tax, because $10,000 would be a house that costs what, 1 million? Yeah, it would be, oh yeah. So it starts off very quickly. The SALT limitation I think affects younger people than we are, because most of us have our houses that we purchased years and years ago, and we're keeping our property tax basis by not moving. And with Prop 19, we're going to be able to move those property tax bases to houses that we live in, but we're not going to be able to pass them on to our family members. So the SALT limitation, in my view, hits mostly families, young families who are buying their first house, as well as, and they're hit from the income tax and the property taxes that applies. Well, amazingly, what they're proposing right now would increase that limitation from the $10,000 to somewhere between 70 and 80, because I keep seeing this thing being scored, and 72.5 was one version, but 80,000 is another version. It would also allow trusts and estates to deduct up to $36,250, which is like half of what they were going to allow on an individual return, because sometimes properties are held inside estates and trusts, and not only do estates and trusts pay income taxes, they also can own property and pay property taxes. I think a lot of people would look at this as being a fantastic benefit for them if the SALT limitation came through. And from the discussions that I've been in the last couple of weeks, it would not surprise me if they were able to bring this back. Wouldn't apply to the year 2020. It would be going forward to 2021. Okay. And I'm going to comment at this point, because I don't have it anywhere else in the lecture. A provision that did come through, and it did not have to be a law passing. So this was a procedural acknowledgement on IRS passes, that on IRS procedures, was that pass-through entities could do a pass-through entity tax. And California is struggling with this right now, but let me describe what that means. If you receive pass-through income from a partnership, and it could be a partnership you worked in, for example. So the partnership has pass-through income. If the partnership says, look, we will pay, you're getting the income from California, we'll pay the state of California taxes at the entity level, and you can take a credit on your personal return for that and treat that as if you paid it, and it would cover that much of your income from it. So right now, California is quick like a bunny trying to put together their rules on whether pass-through entity taxes are a way that's a workaround to the limitation of the $10,000. I attended a session earlier this last week, and for some taxpayers, this is going to be something that's going to help them. And it's a year-end decision that has to be made as to whether or not they're going to be able to participate. The entities themselves have to make the decision first, but give it as a choice. So a number of two different fronts attacking the SALT limitation. One, a pass-through entity tax that some people whose income comes from the pass-through entities will be able to consider, as well as an increase in the limitation. And you can imagine if they do bring that SALT limitation up to the 72,500 or more, then there's going to be a lot more people itemizing their deductions, right? Because as we started off with the standard deductions being down there at 25,001, of the 25,100, 10,000 is the max that is a component of that can be property taxes. They raised that up to 72. In the areas that we live around here, you're going to see a lot more people going back to itemizing their deductions. Okay, another thing that they're looking at is killing off backdoor Roth conversions. And this would be effective for next year, I believe. So any of you who have been doing Roth conversions, you may want to look at how that's changed in the last year or so, and seeing if you want to make any more, well, you will be able to continue to make Roth conversions going forward, because Roth conversions bring money into the federal coffers because you pay taxes on it. But the backdoor Roth conversions is the hop, skip, and a jump. It's a way of putting money into a non-deductible IRA. And once it's inside the non-deductible IRA, then moving that money over to a Roth. And because you may not qualify to put a Roth amount in the first place. So the government's looking at that, saying, who are the people that are using this? Are they the people who are wealthier in the first place? And why do we want to keep allowing them to do it? Okay. There's also a tax, and this one is probably a funding mechanism that's likely to get in, is a tax on mega IRAs. Hard to believe that some people do have over $10 million held in their IRAs. And what the government is saying is that they would look at a way, want to look at a way that they can tax that money sooner. Okay, so if there's an excess of that in the IRA, they do not want continued deferrals. If it's an IRA, or if it's a regular one, how they would require people to distribute out, to bring it down to a level. The government knows that there are trillions of dollars sitting untaxed in IRAs. And the sooner they can get their hands on the money, in their view, the better. Okay. So these are just some of the pieces that are included in the upcoming package. And what I'm going to do at this point is, before we go to our next segment, which will be the retirement plans, I'm going to ask if anyone wants to read me. Well, you can't read me, but you want to tell me what kind of, let's see if I can see it in questions. Are there any questions here that I can look at? Let's see. Okay, for the 3.8% net investment income tax, is the threshold adjusted gross income, modified adjusted gross income, taxable income, or something else? And I guess the best answer to that is something else. Okay, when it comes to the threshold for the net investment income, what we are able to do is, after we've added up our net investment income categories, they can be offset by taxes paid on them, and in some cases, investment expenses. Now, this is a screwy thing because you're no longer able to deduct on Schedule A your investment expenses as a miscellaneous itemized deduction. So I have had trouble in my mind visualizing how they continue to make adjustments, but there are a few categories, one of which is the taxes you pay on the income that's included investment income before they apply the 3.8%. So it is a modified, but it's not modified by what the usual adjustments to gross income are. It's pulling the net investment income categories themselves. It's not all of your income, it's only the investment categories. Wages aren't part of this calculation, okay? Ordinary interest, well, interest would be, but I'm trying to think of something else that wages that would not be in there, because interest, dividends, capital gains are definitely in the piece. Okay. So let's see. Regarding the trust tax structure, what impact does this have for assets, dividends in a revocable living trust? Okay, let's distinguish this. I would bet that most of you have a living trust as your way of dealing with your estate planning. And the concept behind a living trust is that while I'm alive, I create the trust instrument. The trust instrument is the document itself. And what that document says in it is, I have put my assets in here, and the trust now owns those assets. And when you create it, you are the grantor of that trust. While you're alive, if it's a living trust, you're also the beneficiary of that trust, and you're also the trustee of that trust. So you're wearing three hats. I'm trustee of it, I'm grantor of it, and I'm beneficiary of it. When you have a trust like this, a grantor trust, like I just described, your living trust, okay, it doesn't pay any special taxes. You hold your assets with the title showing the trust owns it, but you use your social security number on the accounts, and you don't have to file anything special because all the income gets reported to your personal 1040. Okay, so the trust structure itself would not be affected if it's a grantor or living trust. Okay, so the higher trust tax structure, however, is the kind of trust that, well, let me give you an example. Often people will have a trust set up at the time their spouse dies, or here's a better one, making a trust for your grandchildren. Okay, and you do the trust that you set aside for your grandchildren, you set up while the child is alive and young. And while they're young, you would prefer that the assets inside that trust not be used, but accumulate so that someday there's plenty of money there to help pay for their education or maybe help buy their first house. Now, that type of a trust is a trust that would be subject to these higher tax rates because it's not distributing its income. And when you have a trust like that, you look for provisions in the trust that gives discretion to the trustee as to whether or not they want to distribute any money out and help pay for things for the child during the year so that they aren't paying at the higher rates. But if the trust document says, hang on to this trust and keep it intact until my child reaches age 30, and then you can give them the money, then if the income inside the trust stays in it, then that's when it's subject to those onerous tax rates that we showed as we first began. Okay, so there's usually provisions in there that give some discretion to the trustee as to whether or not the trust keeps the money or pays the taxes on it, or whether it makes a distribution. So that's what that was referring to. Let's see. What is the status of converting after-tax contributions to a 401k or IRA to a Roth? Well, as of today, like we were just saying, you can still do a Roth conversion. But here's what's different than it was a few years ago. A few years ago, if I were doing a Roth conversion, and I had a lot of clients that we were doing this with, we would convert a amount of money that we thought, okay, we might want to pay taxes on this, but we could do a do-over. So 3 years ago, if we were doing a Roth conversion, a client might move $50,000 from their taxable IRA into a Roth IRA. And what we would do is we would prepare the tax return the next year. We'd look at it and say, here's how much additional taxes you're paying because of that 50,000. And sometimes the client would say, oh my goodness, I didn't mean to do that. Or we'd look at it and say, that 50,000, you had more income than you anticipated. It's put you in a situation where it's going to affect your Medicare premiums next year. Let's move that back and put some money back. We could do that 3 years ago. We can't do that now. They changed that rule. So if you take something out, there's no do-overs on it. So that makes it a little more chancy. But as of today, you can still do a Roth conversion. And I tell clients is you convert as much as you want to pay taxes on. Now, why would someone want to pay taxes on that? A IRA is an asset that if it's included in your estate, and if you had a taxable estate, for example, if they do drop the 11 million down to 6, and the house that you're living in is appraised at 2 million, then there's a potential with your other assets that you may end up with a taxable estate. The problem with having a taxable IRA as part of that estate is that it's going to get taxed twice. The way it's going to get taxed twice is that it's going to get taxed as part of your estate, potentially, if the estate rules have dropped so much that you're exposed to estate taxes. So you're going to have an issue with it being taxed as part of the estate. And when your beneficiaries of that traditional IRA pull the money out, they get to pay taxes too. So one thing you can do, and this is, wrap your head around this, okay? If I were in that situation, because I was looking at the potential estate taxes, one thing I could do is do an IRA conversion from my traditional over to a Roth. If I do that, I'm going to pay the taxes now. Kids won't pay it later. I will pay the taxes now. Because I'm paying taxes now, my estate's going to be lower too, isn't it? Because I'm using up part of the money. Okay, so you get a benefit by doing the Roth conversions. So there's been talk among some commentators on financial commentators about, does it make sense to go ahead and do Roth conversions at this point in time? Up to you. For many people, the tolerance for taxes is not high. And while they're alive, they have their entire lives tried to avoid taxes. That's why they've got such beautiful IRAs. And they don't like the thought of paying them while they're alive. And they figure whatever the kids get, they get. Okay. So it's wherever you're coming from on it. Yes, you can do a Roth conversion at this time, but be careful when you do it because it's no do-overs. Let's see. I know that we're going to take a break here in a few minutes. There's a question about round 3 rebate credit. For 2020, the income was appropriate to receive the money, but for 2021, the income is way over. Does the $14 apply to income from 2020 or 21? The $1,400 is 2021. If you received it and you don't qualify in the year 2021, you don't have to pay taxes on, you don't have to give it back. Okay. It's treated just like the one was last year. If you don't have to give it back, you make the calculations on your return. You just don't get more. Let's see, another question. I assume the 600 charity AGI deduction is for 1 year only. Yeah, 1 year only. And we don't know if it's going to, anything's going to extend past 2021 because that was brought in as part of the stimulus acts that came through. Let's see, retirement medical premiums deductible. Retirement medical premiums. Medical premiums are deductible for self-employed people, okay, if they are related to their business. And for individuals that itemize, if they are paid out of personal money, they would be subject to the itemized deduction rules on that. Now, with that said, I'm going to say, why don't we take our 10-minute break at this point? Can someone chime in and let me know that that's where we're going to be?
That sounds good. Let's go ahead and do that. You have the forum.
Thank you. We're back, and the last segments we're going to be dealing with until about 11:45 when we end is going to be retirement distribution rules have changed. So we're going to make sure that we're on the right page for that, and maybe some new ways of thinking about those funds, as well as a checklist of year-end things that we can do now that we've had a chance to think about what the income looks like. Okay, so as we begin now, we go to retirement funds were never intended to stay in your account forever. Oh, really? I mean, many of us have been such good savers, and we've been so pleased with that. And now we're looking at the amount of money in those funds, and we're a little shocked with how much it is. But if you think about that, the government has not got to tax most of that money. And so they are going to encourage you, okay? And in fact, not just encourage you, they have set in motion mechanisms which change how quickly money has to come out of those accounts. So with the Setting Every Community Up for Retirement Enhancement Act, that spells out SECURE, SECURE. Yeah, that's the act that changed a lot of the provisions that affect when and how we take out the money. So some of these changes are effective during the plan owner's life. That means while we're around. And other changes affect distributions after the plan owner's death. So being aware of how it affects us while we're alive, as well as how our beneficiaries are going to be expected to deal with the funds after we're dead, that can make a difference in our attitudes about how quickly we want to use up or deal with the money that is in these accounts. So during the plan owner's lifetime, that's the changes we're going to look at first. We're going to look at our look at it. One of the big things is that the maximum age for traditional IRA contributions has been repealed. It used to be that you could no longer contribute to an IRA, even if you continued to work. You couldn't put money in an IRA after you hit the age 70 and a half. So as of today, you can. If you've taken a part-time job, if you do some consulting, and you have positive self-employment income or wages that are being paid to you, doesn't matter how old you are, you can still look at it in terms of, does my overall income allow me to continue to contribute to an IRA? And do I want to? Does it give me a tax benefit for that? Because people are continuing to work past traditional retirement ages, and there's such a, oh my goodness, difficulty in finding people who are competent to take on some of the jobs nowadays in our communities. So because people are continuing to work, some of them have to work because things have changed, Congress removed the age restriction impediment to continuing with retirement savings. So the rules allow an individual of any age to make contributions to a traditional IRA as long as the individual has compensation. So watch out, though, because many of us are also at the age that we're making qualified charitable donations. And if we're going to put money in at the same time we're taking it out without paying taxes on it, okay, then we need to make sure that we understand what the rules are when it comes to that. There's a new penalty-free withdrawal exception that came in with the SECURE Act. Probably doesn't affect us, but it can affect our kids. Up to $5,000 per person can be withdrawn penalty-free related to the birth or adoption of a child. If a married couple each has an IRA, okay, then we've got two 5,000 because it's per person. And as screwy as it gets, this is one of those provisions that married filing jointly can be two people both taking their 5,000 out. It's so married couple can take up to 10 if it's related to the birth or adoption of a child. Otherwise, there used to be penalties for taking money out before you hit age 59 and a half. You used to be required to make sure you took money out by the time you hit 70 and a half. But now that required minimum age date has been raised to age 72. There's no halves with this one. It's age 72. So if you reached age 72 this year, you must take your first RMD by April 1st of the year after you reach age 72. That old April 1st rule, the old April 1st rule was, and the 70 and a half made it sometimes kind of fluky to calculate when you had to take the money out. But the issue remains, if you don't take it out in the year that you turn 72, because you're still gainfully employed and having other income, or you had a big capital gain and you don't want to stack any more income into the year, then you can wait until the next year. Okay. But it has to get out of there by April 1st of that next year for the 2021 year. And you would also have to make 2 distributions in the same year. So you have to have the distribution for the year that you turn 72 by April 1st, and the distribution for the normal age 73 year would have to be done by December 31st. So the recommendation is that you normally would want to start the distributions in the year you reach age 72. That's not always the case though. And so if you're looking at making that decisions, what do? Well, my recommendation is that you model it. And by model it, you say, what would my taxes look like if I did it this year versus what would my taxes look like if I do it last year? And we do have to make the crazy assumption that the rates stay the same, but it'll get it close so that at least you can see what might make more sense. Watch out. Sometimes you can't fight the required beginning date, but sometimes you can. Okay. RMDs are required if the retirement plan is an IRA, okay, or the account owner is a 5% owner of the business, okay, or the account is a Roth 401k. Did you realize that you have to take RMDs from a Roth 401k, but you don't have to take them from a Roth IRA? Oh my goodness, if you have money sitting in a Roth 401k, you may want to roll that money over to a Roth IRA if you don't want to be put in the situation of taking RMDs out of the 401k. And the inconsistencies in the rules, the quirks, you really got to know them or you find yourself not following the rules because they don't make sense. Okay. Let's see. So looking at these rules, they're required if, okay, the plan is an IRA or the owner is a 5% owner of the business. Well, I could not be a 5% owner of my business, then I wouldn't have to do it. But if that's not a choice, what if I move the money out of an IRA? And nowadays, you can move money from an IRA to a qualified plan. So if you've still got a 401k back at the employer you had 10 years ago, okay, as an example, you can contact the administrator of that 401k and say, would you accept some of my IRA money into the account? Most of the time, they will say, sure, we'll accept any money, but anything that comes out of here is going to be taxable to you. Yep. Okay. So you can move your IRA over to that 401k and it can stay there and not be taxed and not require you to make required minimum distributions on it. Okay. The Roth IRA, those can be moved too. Sometimes you have to make sure that that works, but the Roth IRA, you're not doing it because you don't want to pay taxes on it right now. You're moving it out so that you don't have to take money out of a beautiful machine that is accumulating income that will never be taxed. Yeah. So there's sometimes planning opportunities for those who don't want to begin their retirement income while they're still working. Okay. And that's the point on this. So ask a lot of questions, find out what your company does and what's required and what's not. Here's a few of the RMD basics. Your required minimum distribution is the minimum you must withdraw, but it's not the maximum. You can take as much as you want to. You can take as much as you want to pay taxes on, right? The rules apply to almost all qualified plans and IRAs, but they apply in buckets. For example, if you've worked at a nonprofit or a school system, you may have some 403Bs. Put the 403Bs all in one bucket, even if you've got 3 different companies that each are holding 403Bs. And if you have TICREF, my goodness, TICREF, they do it by contract. So you could have, I have one client who has a dozen different 1099-Rs we get because of the TICREF rules. And none of them are combined. Each one of them's totally separate and laid out, but they're all in the same bucket. Okay. The next bucket, IRAs. Sometimes people will go to one bank that's giving very high interest, or what's high interest? We don't see that anymore, but a better yield than another, and set up an IRA for 1 year, and the next year go to another location and set up another IRA because they can invest it differently. So if you have 3 IRAs, put all the IRAs in a bucket. So we've got 401k bucket, 403b bucket, IRA bucket. It may be different from your SEP bucket if you've been self-employed. Okay, and you've got each of these buckets. Now, when it comes to the RMD, you do not have to take a little dab out of every single one of those accounts. You may have 8 accounts there. You don't have to take it out of 8 accounts, but you do have to take it by the bucket. Meaning, if I go to the 401ks, I can calculate what's the RMD for my 401ks, and I can choose which one I take it out of. I may have 3 to 5 IRAs. I can choose which one I take it out of, the IRA bucket. Okay. And this becomes important. A few years ago, one of my clients did not understand that distinction. We calculated what his RMD was, and so that he knew what the total was, because we were just doing planning of the total income that was going to come out without a distinction of which bucket. So he notified one company to send him that full amount of money. He got to the end of the year, and all of a sudden one of the other annuity companies said, to protect you from what could be 50% penalties for failure to take an RMD, we have included this check for your RMD for the year. So at this point, this company is sending him money that he doesn't want, and he doesn't understand it, doesn't ask any questions, lets that check sit there, just being angry about it, and the period of time for him to have dealt with it passes. But the other thing is, they were right. He had to take it out of that particular bucket, and because he hadn't, he couldn't not take the distribution. Okay. So make sure that you understand the distinction between the types of plans that you have. I usually recommend to people that they try to consolidate plans that are the same thing into one place so that they don't have a problem with not taking it from the right one. And maybe the way is, if I have 5 IRAs, each year I pick off one and I drain it and then go to the next and take and use it up, whatever works. But understand the distinction between the types of plans you have and the requirement that you take the RMD for that category of plans. When it comes down to it, the plan owner is the one that's ultimately responsible, because the plan owner is the one that faces potential penalties for, it's called an excess accumulations penalty. The failure to take your RMD can be subject to a penalty of 50% of the amount that you didn't take. And the category is called an excess accumulations penalty. Like I said, the government knows that there's so much money in retirement accounts, they've got to get it out to get their share. So you have a couple jobs when it comes to that. And to some extent, the government has required the holder of your qualified plan to send you a notice telling you what your RMD is for the year. Now, some companies are better than others about this. Some of them tell you, based on this, your December 31st value, here's the amount that you have to take out, and it's very, very clearly written. Others, they let the mid-year notification to the government of the total dollar value of your account be the check the blocks, yes, they're subject to it, yes, this is how much it should be. So you have to be a little crafty about, how is my company letting me know how much I need to take from those accounts. But once you've or you can do the calculation yourself, because there's a government table that we use saying based on your age, what is the divisor, the amount that you need to take out based on your age and the type of beneficiary you have. So then you can choose which account to take the distribution from, but don't overlook making this calculation annually and taking it, even though they are telling you each year that you must take a distribution. Interestingly, if you also have an inherited IRA, inherited IRAs, back when this third-party reporting that's required for regular IRAs and qualified plans, but back when that rule came into play, the banking industry, the brokerage industry, they're the ones that are responsible for telling you this information, negotiated with IRS and said, how would we be expected to know what the RMD would be for an inherited IRA? And they got that category exempt from the annual requirement that you be notified about how much you have to take out. So if you have an inherited IRA, not only is the burden all on you, that you're ultimately responsible, you're probably going to have to be doing the calculation yourself as to what it should be and jogging your own memory. Sometimes I suggest to clients that they work with the companies that are holding these and choose a date. Maybe Thanksgiving would be a good day to take the IRA, because that way it's close to the end of the year. It's had the opportunity to earn as much as it's going to do before you take it out, and you get it out before the holidays. Or for some clients, we choose their birthday to take it as a way of not forgetting that it needs to be done. Yeah. Now, I mentioned that there are penalties, and it's the excess accumulation penalty, and it's 50% of the amount that you didn't take. But I can also tell you, anytime I've had a client who's forgotten to take it, we calculate what the penalty is, and then we request a waiver of the penalty, so that IRS after the fact doesn't come back in and say, aha, you didn't tell us that you didn't take your RMD and that you should have, and we're going to invoke a penalty. You be proactive about it. You fill out the form 5329, which is the form that you calculate the penalty on. And then you go in and say, but I request a waiver because. Now, as I mentioned to one of my clients, it's tough for us to say that they've had memory problems more than 1 or 2 years. You know, it's like, well, what have you done to resolve this? And you always want to plead that there was some kind of event that kept you, a reasonable person, from not knowing, but not acting to get that money out, and that you've remedied it. You've already taken the distribution. It'll show up in a different calendar year to be taxed. So if you didn't take it out in 2020 and you took 2 in 2021, you don't have an income extra in 2020. You have 2 distributions in 21, and that's how they'll be taxed. So make the request for the waiver, and I've not seen IRS deny those requests. RMDs cannot be rolled over to another tax deferred account generally, okay, generally on that one. And can you believe that there are still some accounts that have a different RMD start date, and that's if you have a 403B plan that has pre-1987 contributions. Instead of the 70.5 or 72, that mandatory start date is 75. So lots of little confusions, but if they apply to you, they mean something that can often help you out for a year or so. Here's some changes to the distributions after the plan owner's death, and a new provision that came in with the Secure Act that, I don't know, to me, it bothered me. I'm still trying to figure out how can I get around this one. And what this is, the Secure Act requires that the entire balance of the participant's account be distributed within 10 years of the plan owner's death. And that requirement went into effect for anyone dying after 2019. So anyone who passed away in 2020 or 2021 is under the requirements that the person who has their IRA, with some exceptions, we're going to look at those exceptions because with taxes, you always go for the exceptions, okay, that generally the entire amount has to be distributed out within 10 years. regardless of whether the participant dies before, on, or after the required beginning date of age 72. So it's the participant is the one who died, okay? The person who's receiving it. And I'll give you an example. Part of the beneficiaries of my IRAs are my grandchildren, and part of them are their parents, my children, okay? So in that situation, I looked at it and I said, well, I hadn't thought, I wanted to set up a lifetime stream of IRAs that were in Roth accounts for my grandkids. And now, after my death, they're going to have to take it in 10 years. Well, you'll see, it depends on how old they are when I die, okay? But still, it's a much shorter time, because we've talked about those stretch IRAs and how wonderful it would be to have the ability to keep accumulating. Well, we thought it was a great idea because there was no tax during that whole accumulation penalty. And the government says, yeah, a little too good to be true, and we want the money. So for the grandkids, the rules will be that they have to start taking the money out at the point that they reach age of majority in the state they're living in. So if they're California residents at age 18, if I die and they're only 12, it can stay inside that account for 13, 14, 15, 16, 17, 18, and then at 18, the 10-year period begins. Okay. Then also for my own kids who are not under 18, in their situation, they have a 10-year rule. So, and they are not going to qualify for one of the exceptions. We're going to see in a moment what those are. But because of that, I look at it and say, they're going to burn through my life savings, those IRAs, within 10 years. That was the alarming part of this, which made me start thinking, is there a better way? Okay, so let's talk about the exceptions to this new 10-year rule, because the rule starts out very straightforward, saying, here's what it is, here's how you do it. And if you've got multiple plans, okay, then you have the money will still come out of those. It's a 10-year rule. Okay, beneficiaries after the Secures Act. Now these designated beneficiaries, we're going to have a category called a designated beneficiary, and actually 3 categories, which you'll see as we put them out here. So there's designated eligible beneficiaries, and the stretch rule still applies to them. So if I pass away and have money in my IRA and my spouse gets it, and when the spouse gets it, they can choose to say, it's a spousal IRA as a beneficiary, or I can make it my own. I can just take that money, put it with my IRAs, or I can put it in a separate account and roll it over as a spousal IRA. So eligible designated beneficiaries, the stretch rules still apply, meaning go to the life expectancy tables and calculate your RMD just like you normally would. If it's a spouse, a disabled person, or a chronically ill, as defined in a specific tax code section, yes, it's not just saying you're chronically ill, you have to qualify based on this tax code section. Generally, chronically ill in the tax world is having a condition that's expected to lead to death. So it depends on how long it's going to take. And eligible designated beneficiaries, the stretch applies if the person who inherits it from you is not more than 10 years younger. And I'm trying to think, an example of this would be one of my siblings. If I left my IRA to my brother, for example, he's not more than 10 years younger. And so the stretch would still apply because it would be very similar to my own life expectancy distributions, right? Which would be going out. Now, a minor child of a descendant, okay, the stretch rules still apply until the minor reaches the age of majority. So this particular provision is kind of an odd way of phrasing it. I'm not sure Congress intended it to work this way, but the interpretation of this portion of it that says a minor child of a decedent presumes, or the government has taken the position that they're presuming, this means that RMDs need to be taken during that period. When I said my grandson might be 12 and his 10 years starts when he's 18, what this is describing is that period from age 12, 13, 14, 15, 16, 17, 18, that a distribution needs to be made. And then clock stops, rules change, we have a 10-year rule. That's how this provision, minor child of a descendant, and the rules for the stretch payments are currently being interpreted. And then it says certain trusts. Now, certain trusts is not your living trust, but it would be a distribution trust. We'll see what kind of special trust, and I'm going to suggest one in a moment that might be able to get around this 10-year rule. Okay. The next category is a non-designated beneficiary. If you pass away and nobody can find your beneficiary designations because you didn't make one, okay, then whoever gets that money has a 5-year rule for a death prior to the required beginning date, or they look at the descendants' remaining life expectancy for deaths on or after the RBD. Okay. So for these situations, the 10-year rule, charities can apply for, can be in this category, or the client's estate. And unfortunately, what happens with the client estate is that often they get stuck with, if it's being probated, the probate judge saying, get the money out, give it away now, we're not keeping this probate open. So you always want to have a named designated beneficiary when you are doing your IRA type planning. It's so important. And I've seen situations where a spouse dies and the bereaved survivor doesn't think about it for whatever reason, and they don't go in and change their designated beneficiary. And guess who the designated beneficiary was? It was their spouse. And there's language built into those forms that you fill out. And often they'll say, if the primary beneficiary is not there, then the default beneficiary is, quote, your estate. Well, my goodness, I've seen situations where taxpayer had an IRA, it was a significant portion of their estate. The IRA was not in their trust because it didn't belong to the trust. And those are not normally held by a trust. They have a designated beneficiary as who gets it. So it isn't important as much to put it in the trust first. And you can't, it's the nature of the instrument itself. So in that situation, the probate had to be open just because of the IRA, okay, to get it to where it could be moved. And that's because the wording on the document that the person filled out when they opened up the IRA, they had first named their spouse, and the wording that was typed in after that is, if that spouse were not alive at that point, that it went to the person's estate. And the company that was holding it took that word for word and said, it goes to their estate. You've got to open up an estate, and then the estate has to show us who the people are. And because it had to be done through a probate, at that point, the judge said it all goes out immediately. They didn't even give them the 5-year rule. So go back and check your beneficiary designations. That can be really important. It's not like you know that they'll never ever be used because we do not have an infinite life expectancy. So beneficiaries after the Secures Act, these non-designated beneficiary, the 5 rule applies. That's having to do with the charities, a client's estates, and certain trusts. The non-spouses, the 10-year rule for designated beneficiaries that fall into the non-spouses category and certain trusts. Okay. The new 10-year rule for designated beneficiaries to take distributions applies equally to both Roth and pre-tax accounts. That's kind of a kick, isn't it? We've saved so hard to get those Roths built up for the kids, and now they have to take the money out. They don't get to wait. So we have a 10-year designated beneficiary for anyone who's inheriting this, and this non-spouses, this is our kids primarily. So let's talk about some strategies of, is this really what we want? Do we want to get that out? There are no RMDs within that time frame, but the account balance must be zero after the 10th year. So one strategy might be to write a little note to the kids, you're going to be coming into a large amount of my IRA money. Don't spend it all at once. But you have a choice. You can leave the funds alone and not touch them for 10 years. And on the end of that 10th year, go in and pull the whole thing and pay taxes on the whole thing at one time. You can look at your own life planning at that point, the beneficiaries, and look at what type of opportunities you have. If you're still working full-time, and you will be for a year or two, then you don't have to touch it for a year or two. If you look at it from that perspective and say, okay, since I'm 50 now, okay, and I'm going to work for 5 more years to make sure I get my full retirement, okay, even though I don't have to take that retirement at that point, I'm going to make sure I get the time in to do that. And then between 55 and 65, I have, 55 and 60, because 50 of the time that you inherit it, I have to pull money out of mom and dad's IRA that I inherited. So I can look for changes to the situation as opportunities to release funds in lower bracket. Perhaps they want to take a 2-year sabbatical to travel and not do anything, don't make any money, but travel and enjoy themselves. That would be the time that they can pull from that IRA. Gee, I bet mom and dad wish they had done that while they were still alive. But one of the other things is to reconsider lifetime Roth conversions. And those reconsidering lifetime Roth conversions is on our part in terms of rather than, because you can imagine if the kids are going to inherit this and then have to stack an enormous amount of income on top of their regular income, they're going to lose a lot in taxes. And as I said earlier, especially if I were in a situation where I was paying estate taxes, it might make sense for me to keep moving money over to that Roth, okay? So that when they're in that period of short period of time where they've got to pull all the money out, that at least the part that they're pulling out from the Roth isn't being taxed and not adding that extra burden on that. Okay. So there's a number of strategies here that we look at that we would want to think about to get around some of these rules. Now, another one that I would put on the discussion table is considering a CRT beneficiary. What's a CRT beneficiary? CRT beneficiary is a charitable remainder trust. I have worked with charitable remainder trusts for many years, and I've seen a lot of success stories in terms of the money that's gone into these charitable remainder trusts, continuing to grow in value to the extent that years later, there's still as much or more money that is remaining in that trust, even after the required annual distributions that came out of it. So, and I believe that's a win-win on the charitable remainder trust, because the charitable beneficiary at the very end gets the money. The income for life of the person who's the beneficiary of the charitable remainder trust, and for estate tax purposes, it's the portion that is the remainder interest in an estate will be a deduction for a charitable bequest out of the estate. So there'll be no estate taxes charged on that portion. But when it comes to the added benefit of using IRA monies for this and being able to stretch out that distribution for greater than 10 years, I think it adds an extra gold star next to it as something to consider. So the mechanics of it would be such that at the taxpayer's death, that they would have probably a testamentary charitable remainder trust set up, asking that the retirement funds be placed into a charitable remainder trust, the entire amount of it, and that the beneficiaries of it, and you name your child, and it could be your child and his spouse if you want, make sure they're both covered. And that at that point, your estate gets a deduction for the amount that is calculated as the remainder interest. The life interest is the expected amounts that will be distributed to the family member over that 20 years. You have to make sure that the CRUD itself passes what's called an exhaustion test, so that it is unlikely that it'll run out of money within the period that you are likely to be making the distributions. But I've seen these set up for example, a term certain of 20 years. We are still feeling our way trying to see if IRS is going to respond saying, no, you can't do them, set up these CRTs for less than 10 years or more than 20 years or whatever constraints being placed on it. I've had some complaints from people saying, if I do a CRT that's part of a holding IRA funds, then it's going to be ordinary income. Well, is that necessarily bad? Because if I took it all out in that 10-year period, it would all be ordinary income too. Okay. And the benefit of it being in a CRT is that on an annual basis, we look at what money is available to distribute, and we take of the current year income first, and then we reach back and say, I haven't got enough current income to handle it. Reach back, the clawback is all of this ordinary income that you put in from the IRA. So I think that it's a reasonable thought to consider, and if you have an estate attorney you work with, that might be something as a way of stretching out that 10-year period. Now, maybe you don't have that feeling about your kids blowing the money in 10 years, and I don't think my kids are going to blow the money, but it just seems to me that it would be a win-win for everyone involved to consider a charitable remainder trust as the IRA beneficiary. Okay, let's see. I'm going to see if there were any questions that came in on RMDs for about 5 minutes, and then I'm going to go to the year-end planning portion so that we start that in a few minutes. Let's see. Okay. If charities are the designated beneficiaries of one's regular IRA, is the IRA omitted from estate tax ceiling and or from taxes of any kind? As I said before, charitable requests, and this is, I think what you're saying is not a charitable request, but it's on the designated beneficiary line, you have the specific charities spelled out so that it never has to go through an estate evaluation. It just passes to the charity. And that's perfectly fine, okay? Because even if it did come into your estate, it would be subtracted out of your estate. So it wouldn't be subject to estate taxes. It would, however, be taken into the total consideration of whether or not an estate return had to be filed. You know, sometimes you have to file an estate return even though there's no estate taxes. So in terms of triggering whether you not file or not, it would be in the mix because all of your assets are in that mix. Let's see. If my beneficiary of my IRA is also requiring RMDs, does it increase her RMD basis requirement? Yes. If for example, if your RMD beneficiary, if your beneficiary of your IRA was a brother and the brother's almost as old as you are and he's taking RMDs out of his own account, then he also has to take RMDs out of the inherited account too. So yes, it would increase because yeah, it would make sense because the total value in them has increased, so the distributions would increase. I'll move on now to the year-end planning, and we'll talk about if there's still a few things that might be worthwhile, because one of the questions I saw is something that we need to talk about as year-end planning strategies. When it comes to doing year-end planning, since we are trying to manipulate the amount of income that's subject to tax, and you might be looking at it from two perspectives. So much goes into our heads about how do I not have to report as much income? Well, sometimes people have gotten so good at that that they end up with no tax on the return anyway. And I always tell my clients, you want to have a positive tax bracket because this ability that you've had to save for so many years and accumulate, at some point, it's going to crescendo and fall down on you, and you're going to be in a higher tax bracket that you can't that you can't get away from. For example, a person who retires early. Okay, I have had more than one client who have not come to me to talk about this in advance, and when they come in, I say, "Oh my goodness, what happened? Your income disappeared." And he says, yep, I got the opportunity and I decided I was going to take it. So I stopped working and I didn't want to pay any taxes this year. And I says, well, you're not paying any taxes, but you're wasting a lot of deductions. And they says, what do you mean? And so here's the thought. Drive the income so low that, remember that standard deduction that was over $25,000 for a married couple? If you get your income so low that you don't even use that up, okay, then you have wasted the opportunity to move money out of an IRA account, for example, that would be ordinary income, and get it out of that, that's going to be taxed at those high rates, and get it into something that would be producing income that would be taxed at a lower rate, and the principal of it won't be taxed again. Okay. If you have been for many years in a 30, 32, 35, 37% tax bracket, and you run your income down to where you're paying no tax, if we look at it and say, my goodness, once you hit Social Security age, you're not going to get a chance to delay receiving it. Once you hit IRA RMD age, you're going to have to take money out. Those two things are close in years in terms of coinciding. And we take just those two pieces and add it on top of the investment income that comes in, and you're not paying at the 10% or 12% rate. You're back up there at the 20+% rate. I'm trying to look at a chart so I can get an idea real quick. But you're putting yourself in, you're losing opportunities to absorb income at the lowest rates that you can. And another example of that would be if you find yourself in that situation and you say, well, I didn't need the money. Okay, well, if you don't need the money, then it's an opportunity for a Roth conversion, because since I don't need the money, but I will have to pay taxes on it for the Roth conversion, it can easily move it over and feel good about bringing that over so that nothing ever gets taxed again out of the account that grows as the Roth. So in addition to being able to reduce your income, there are some years where you may want to increase your income. Then you look at it in terms of, are you able to increase the amount of deductions available to yourself? Are you taking advantage of every opportunity to reduce your taxable income because of the deductions that are available and how you use them? Okay. So that's where you start when it comes to tax planning, is with these questions. If you believe rates are only going to get higher in the future, then when we start looking at what do we want to do for this year, you may want to say, if rates are going to be higher later, then I want to take a little more income out now. I think I can handle absorbing it now because the rates are lower. Okay. If you think the rates are going to stay the same, then it doesn't really matter that we stack it up this year. We want to probably even it out, or do a year where we alternate having more income and more deductions versus a year where we take the standard deduction and just have the normal income coming in. So we look at different approaches to how we will balance this out to optimize the taxes that we pay. So here's some things to consider. Bunching deduction still works. And one of the key things that I have a number of clients do is alternating years for itemizing versus the standard deduction. So we've talked about the, I want to look at my quick chart again in terms of those deductions. So I think the standard deduction we said for a married couple was 25,000, gosh, 25,000 plus. I would just leave it at that. So that was the standard deduction for a person. And if I know that I'm going to take the standard deduction because this year I can't get enough things to go above it, then maybe I will want to plan to take enough deductions the next year so that I can go past it. For example, property taxes, I have the choice each year of paying 3 installments or 1 installment because of the timing of how those property tax bills come in. I have a payment in December and I can pay both the full amount in 2 installments in December. If I pay the 2 installments in December, I'm not going to have one in the first part of next year. So then I will only have the one that's due in the next year in December. So I can bunch my deductions. If we have a $10,000 limit on property of state and local taxes, if my taxes are going to exceed 10,000, it's a little hard to work on bunching my taxes as a deduction. But there are some folks out there who have rather low property taxes, and getting over that threshold, it may take putting 3 in 1 year. When it comes to charitable contributions, if I am paying for charitable contributions with a donor advised fund, for example, I can make 1 year a really big year by making a major contribution to my donor advised fund. And then over the next several years, handing that money out and taking the standard deduction, okay, because I'm not going to get to deduct the charitable contributions that I've already deducted when I set up my donor advised fund. So bunching deductions still works. And I can alternate every other year or every 3 years where I go big, go home, or go home with the charitable contributions to get enough deductions to save me some money. If you're RMD age, use your RMDs for QCDs. Now, QCDs, qualified charitable donations. Let me be a little more specific and go into more detail on QCDs and how they work. If you're a required minimum distribution age, and actually that's 72, but you can start making QCDs at 70 and a half, which they changed one part of the tax code and didn't change the other. So you can start making them at 70 and a half. The maximum qualified charitable donations you can make in 1 year is 100,000. If your RMD is 120,000, okay, then the maximum that you can give to charity of that is 100,000. If you say, no, I gave the whole thing, I gave the 120,000 to charity, what happens is, in reflecting it on your tax return, on the face of the tax return where we say, how much did you distribute? 120, then the maximum QCD of 100,000 comes out of that, and what shows as taxable is $20,000. Hold on, just because it shows it's taxable on the front of the return, we're still getting the benefit because we're taking that extra 20 and we're putting on Schedule A as an itemized deduction. Okay. If that's our only itemized deduction, we've lost the benefit, right? Okay. So maybe it wasn't a good idea to do it that way, but if it's going as an itemized deduction there, let's hope we have enough medical expenses or other taxes to put it over the threshold so that we're getting some benefits. So if you're retirement age, use your RMDs for QCDs. I had people at first and said, well, only wealthy people do that. And I said, the average person is the best equipped to get a benefit from this. Why? Because the average person's RMD is much closer to 20 or 30,000. Okay. Plus, their standard deduction is the most frequently used nowadays for that person. And if you were going to make sure that you continued to benefit your church or your favorite charity, and you want to make sure that they keep receiving that amount, whether you take the standard deduction or not, if you take it out of your required distributions, the required distributions don't show up as income, okay? So they do not increase your adjusted gross income. For example, if I had to take out $20,000 as a required distribution, okay, if I take that money and then give it to a charity, here's what it might look like. It would be included in my income for my adjusted gross income. And then when I get to my Schedule A, I would show it as a charitable contribution of 20. Well, if it's a married couple and the standard deduction is in excess of that, I ended up getting to pay the taxes on that 20,000 that I gave to charity, didn't I? Because the standard deduction went nowhere. It was greater than the QCD and it went nowhere. Okay. But if I take the QCD and give it to charity off the top, I've lowered my adjusted gross income and I still get that $26,000 standard deduction. So I'm coming out ahead. I'm doing a very tax efficient usage of getting my charitable contributions out of a way that benefits both the charity and me. Now, one other piece that goes along with that is when we took it off the top, so it didn't show up as income, our adjusted gross income was lower than it would have been had I taken it first and then handed it to the charity. And certain medical expenses, we were saying medical expenses are a fast growing itemized deduction area, but they're subject to your adjusted gross income. You have to absorb the first 7.5% of AGI. If you take the money out of the QCD, your AGI is lower than taking the distribution and then giving it to charity. Okay. And by having a lower adjusted gross income, more more medical expenses will be allowed to you. Okay. There are all kinds of pieces where the adjusted gross income makes a difference. One of the ones that we're going to talk about at the very end of this is my modified adjusted gross income for purposes of my Medicare premiums. Okay. And so by not having that RMD included as income, because I've given it to charity, or reducing it somewhat because I've given it to charity up off the top, I may also be reducing my Medicare premiums. So many things are linked to your adjusted gross income. If you normally make charitable contributions, I'm telling you, when it comes to R&D age, you've got a benefit here. This is something that can be of help to anyone in any tax bracket who qualifies to do it. Let me comment on year-end loss harvesting. I've had clients who got really excited because they've heard of certain kind of funds that they can invest in that will do loss harvesting. And the concept of itself makes sense, but be careful how you use it. For example, what is loss harvesting? Well, we always look at our portfolios toward the end of the year, and we look at it and say, have I taken capital gains? Can I offset any of those capital gains by losses that are sitting there in the account? Okay. If I do, I won't pay taxes on that capital gain at the end of the year. So that's what's harvesting is looking at the portfolio and taking losses. Now we have to fight with the rule about wash sales. If I take a loss, I've got to wait at least 30 days before I can buy back into that stock if I want to continue to own that stock. Because if I buy it back too soon, my loss will be disallowed. It's called a wash sale. So picture a fund that says invest in us and generate as many losses as you want, because they're constantly trading and they are making sure that they're monitoring your losses and accumulating them for them. Well, they're only good to the extent that you've got gains to offset. I've seen people get so excited about this with the idea of, oh, it's going to save me some taxes. The maximum capital loss that you can take in a given year is $3,000. If you generate losses of 6,000 and you only have 1,000 of gains, you've got 5,000 excess losses, 3,000 is usable, you've got 2,000 that you can't use. It's not that it goes away, it goes forward to the next year. But I'm sure that I have some clients who have enough capital losses that they need to stay alive probably for an extended period of time so that they can absorb them. So loss harvesting is understand what it is and if it's doing something for you. Another mistake that I saw one of my clients make is he did loss harvesting, but he did it in a bypass trust. When there are losses inside a trust, losses do not pass out to the beneficiaries of that trust. And if the trust doesn't have gains, or if it has gains that are not big enough to cover the losses, a loss will sit inside a trust until the trust terminates if it can't be used. So make sure that you're capable of using the losses that you generate. I mentioned the loss harvesting to a client the other day, asking, as we were trying to do a projection for the year of what the tax liability was, and I says, well, do you have any losses that might offset some of this gain? And they said, no losses this year. It's been a good year. Well, it has, but I guess that's positive news, and it's always good news when you make a little bit more money. Okay, so let's think about some other considerations here. Secure a loss deduction for nearly worthless securities. This is also an area where people get confused. They think, well, I've lost so much money in this stock, I'm just going to declare it worthless. Your desire to declare it worthless is not what makes it worthless from a tax perspective. You can deduct a loss on worthless securities only if you can prove the investment is completely worthless. It doesn't count if you still own the security and it has any value at all. And this is very frustrating to people. I've had some clients, I've said, look, if you want to make sure you get a loss, contact your broker and have them sell it. And they're saying, but it's not worth enough to sell. It wouldn't cover the expenses to sell. Well, sometimes the brokerage will accommodate you by removing the worthless stock from your account and giving you a notation that it's worthless. Okay. But you can't continue to own it when you've said it has no value and taken a stock loss for it. Okay. Only if you can prove the investment is completely worthless. So I've had situations where a client presents with this large capital loss, moaning about, I've had it for years and I've never been able to use it and it's never going to recover. Well, get rid of it. You know, if it's a stock that is in a privately held company, then you can tender it back to them. You can ask them to take it back and give you notification that you are no longer part of that investment so that you can show that it was completely worthless. It used to be when IRS had a budget okay, where they could actually send people out to ask questions instead of send letters that make you crazy. Okay. It used to be that they, on the list of things that they would audit would be bad debts, losses constantly. I think someday they might return to that when they do get a budget, but this is one that is a target. So make sure that you dot your I's, cross your T's, and go the extra mile to make sure that you're entitled to take the deduction. Loss generating funds are not necessarily your friend, as I said before, but check through them and make sure that where you stand as you start working on taking them for the year. Okay. Other things to consider. Does making Roth IRA conversion still make sense? And as I said, for some people, I think it does. But you need to do some year-end planning where you create a model and say, what does it look like with the Roth conversion, without the Roth conversion? Because you can't do a do-over. If you do it, it's done and you're going to get to pay taxes on it. One other comment I wanted to make is if you are in danger of an underpayment of estimated tax penalty, look for withholding sources. These are just tax tips as we approach the end of the year. If you've had a good year and you are thinking, oh my goodness, I hate the thought of taking my RMD that I have to take before the end of this year because it's just going to stack on and I'm going to owe even more taxes. Well, what can we do? If we pay an estimated tax at this point, the government will see the date that we paid it, and they'll make our calculation of our estimated tax penalty based on the date that they received the check. But if I go for a withholding source like an IRA, you know, you have a choice on an IRA. You don't have to withhold anything, or you can tell them how much you want to withhold. You can have 50% of that IRA distribution go to IRS. That 50% is paying for a whole lot more than the taxes on the IRA, isn't it? Okay. And you can have 30% of it go to California, and you can get a little bitty portion that you can go out to dinner on, okay, out of it. But the money would have been used to pay the taxes soon anyway. So look for withholding sources when you're doing your year-end planning and you're saying, oops, I guess I forgot to pay an estimated tax earlier in the year, or I'm going to owe a lot more than I thought I was going to owe. Okay. And it's not just IRAs. When you have qualified plans, you have discretion in terms of the portion that you withhold for taxes too. Okay. And I put this on here. Consider looking for a tax-friendly state. Okay. Yeah, it's only half joking because we've seen a lot of people who've moved out of California, but California is very generous to people who are not their highest income earners. But as you start earning more money, California becomes more punitive. But if you do think you can locate to a tax-friendly state, you really have to do it right. You have to actually move. You cannot continue to stay in the state and just visit with the post office box you set up in Nevada, for example. Okay. Comments on what's happening with this Build Back Better bill that may get through before the end of the year. I called this one Build Back Better electronically. Is it too good to be true? And will it be included in the Build Back Better schemes on these? Because the tax credit that has disappeared on many of the models of electric cars like Tesla and some of the GM vehicles that had been $7,500, the new auto purchases credit currently is set to be $12,500. That's significant. And there was even a provision that the credit could be available for certain used vehicles too. So things to be thinking about. I know that someone told me that the Tesla pre-orders had jumped tremendously after the draft of this bill came out that raised that credit back up to $500. I mean, $12,500. Let's see. One of the other things, if you are a self-employed person, remember as you go into the year end to take a time out to look and see if you need to replace any capital equipment. The expensing of the capital equipment, the depreciation bonus, it's called 100% depreciation. Well, 100% depreciation means no depreciation. You take the whole thing now. And this can be done on furniture, fixtures, equipment. So if you're looking at things you need to buy within the next year and you want to affect this year's taxable income, remember that you can do a complete depreciation upfront and up to 1 million of those kind of equipments. One of the pieces of advice I want to pass along to you is that I encourage you to be proactive with your tax reductions reporting. Take all the deductions you're entitled to, but make sure you report and report in the right place the income that you receive. And when I say report in the right place, last year, instead of just miscellaneous income, the 1099 MISC, the government added a form that they'd had 15 years before called 1099 NEC, non-employee compensation. Okay. If something comes to you and it's a non-employee compensation, the government is expecting you to pay self-employment tax on that. They may not always be correct that you need to, but make sure you put it in the right place. Excuse me. So that the government is able to find it, because the vast majority of notices you get from IRS are because they don't think you reported all the income, and you may have reported it, but not in the place. Excuse me, they were expecting to look. The last comments I wanted to make have to do with understanding Medicare B premiums. Each year in November, the government sends out a notice to you telling you that based on the tax return you filed for the previous year, your Medicare premium may have been reset. And if it's not the basic level, then it'll be higher. I've had clients call and say they're so upset because their Social Security was reduced. The Social Security wasn't reduced. Their Medicare premium that comes out of Social Security was increased. So you should know how this works, because when you are working with modifying your adjusted gross income and manipulating your taxes, it isn't just income taxes that are going to come out of your pocket. So on the chart you see on the screen, if you file a joint return, which is the second column in, if your modified adjusted gross income, and modified adjusted gross income this time means that in addition to the adjusted gross income you see on your tax return, you add in all of your tax exempt income. That's the biggest piece that gets added back here. So you think it's tax free, but not from this calculation. So if your tax return shows modified adjusted gross income of under 176, you're going to pay the normal premium, which next year would be about $148. If your income surpasses that 176 level, you can see that your premium jumps up to 207. If you have a good year and a large capital gain and find yourself making over 330,000, your premium is going to be $475. So here's an example. A moment ago, we said, well, gee, do we want to do a Roth conversion before year end? Well, watch out when you do that Roth conversion, because it's not just the ability to absorb the income for income tax purposes. If you trip over one of these thresholds, you're going to increase your premium for the next year. And on a married filing joint return, it's the premium for the both of you. So double those numbers that you're seeing in the far right-hand column. It's just, there are so many pieces that go into the taxes we pay, the government levies that we get to address, and trying to capture all of the pieces that you should be aware of as you start this year in process is a pretty big deal. Now, I'm going to go ahead and stop at this point because we've reached our 11:30 time limit. Lynn, do you have any more pieces or any announcements that need to be made?
No. Do you want to do some more of the questions that came in?
Okay, I'll take a few more.
Or do you want to take a 5-minute break?
No, I'm going to go ahead and I will go back and look at some of the questions and see if there's a couple I can answer. Okay, here's one. Person is saying, well, we use the standard deduction and we QCD our charitable contributions. Good for you. But then he says, can we also give a $600 to our donor advised fund? I know that we cannot, I'm pretty sure that the $600 cannot go to a donor advised fund. Okay, and I'm not 100% sure on it, but I'm pretty sure on it because the government goes out of their way to make sure that we can't, from our IRAs, give the money to a charity who happens to be a donor advised fund. They feel like we're double dipping. Let's see. I answered the question that was right above that. The age to make a QCD is 70 and a half. Still, the RMD is 72. Okay. Contributing appreciated stock. This is one of my favorites. I've done this for years. Contributing appreciating stock to a donor advised fund has the advantage of not having the capital gains included in your income and being able to deduct the contribution, but there's a limit on the deduction for donated stock. Yes. And that's an important comment because it draws the other point about the government took part of the lid off of, normally normal rules. Well, what's normal anymore, but the old rules, which will be in effect again in 2022, I believe, limit the amount of charitable contributions to 50% of your adjusted gross income if they're cash contributions, and 30% of your adjusted gross income if they're long-term capital gains. And oh my goodness, you do not want to give a short-term capital gain to charity. The reason you don't is that the charitable contribution for the short-term capital gain property is the basis. It's not what it's worth, okay? And what does it take to be long-term? A year and a day. I actually had someone come in one time and said, I'm so proud of myself. I waited, I counted the days, and on the 1 year mark, I gave this to my church. Yeah, 1 year exactly. He did not meet the requirement. It's a year and a day to be long-term capital gains. Okay, so long-term capital gains donated to charities, beautiful, because you may have paid $5 a share, but that stock's now at 50 a share, and the deduction you get is at $50 a share. So you're not having to report the income, but you're getting to take a contribution for the fair market value of it. The rule right now is 30% qualified capital gains property, and that's to a regular charity. It can be a donor advised fund. And when I say regular charity, the distinction is it can't be to a private foundation because there's a lower percentage that's available on that. Okay, so donor advised funds, gold star for that, and using the stock to do it is fantastic. Okay, let's see. Federal and California tax laws. Oh boy, what should we consider there? Well, California has its own set of rules. Most of the things that I talked about today are allowable on California and federal. However, here's one of the big distinctions that investors run into. California did not eliminate the category for miscellaneous itemized deductions. So your portfolio management expenses, which are not deductible on your federal return, continue to be a deduction on your California return. California also does not have a SALT limit of 10,000. So if you're paying 15,000 for property taxes on your home and $800 on your car, okay, you've topped out on the federal, you're stuck at the 10,000 no matter what. But on your California return, you can still deduct the full amount of the property taxes on your homes and the DMV fees on your car. So those are two of the most obvious ones. California also doesn't have a capital gains break. So whatever you pay taxes on, you pay taxes on. I mentioned QSBS stocks. California does not recognize QSBS stocks anymore. So you may pay 0 on your federal return, but California is going to want their up to 13.3% of the entire amount of the gain. Okay. Those are the high points, I think, of the California federal differences right off the bat. Let's see. Let's see if there's any other questions there. How long should you keep your tax records? As long as they're relevant. And by that, I mean, generally a tax return that is considered a complete return when submitted will close for the statute of limitations for audit purposes 3 years after it's filed. But California has a 4-year statute. So don't throw those things away after 3 years, because California is notorious for opening an examination right at the end of the 3 years. Okay. Well, the other issues that you run into is, let's say you have an opportunity to invest in a non-public stock, and you invest in that stock this year, and 10 years from now, you're trying to say, what records can I throw away? Don't throw away everything in the drawer, because you will need any document related to basis as long as you've got the asset, and then for the 3 or 4 years thereafter for potential audits. So if it's a capital asset and the documents have to do with basis, keep them indefinitely. The tax returns themselves, I usually suggest keep the return. You can throw away the supporting pieces, except anything that has to do with basis. Another place real quickly that I've seen people get caught in California is the sale of their residence. This is not federal government catching them, it's California, because California knows that most taxpayers are not good record keepers. And I can tell you, when you have a sale of a residence at a significant amount, and each of the ones that I'm thinking of that I've had audits on have been in excess of 4 to 5 million. California has come in and audited them, and they've wanted to see receipts. I'm telling you, receipts, not just pictures and speculation, but documentation to show what the basis is of that house with the improvements you've made over the 30 years that you've lived there. And that's tending to be a hot button area for the state. Right now, the state's not as bad off as the federal is in terms of their workforce. It's close, but not as bad off. And so they have slowed down, as the federal has, on most types of in-person. Well, they don't do in-person audits, everything done over the internet, but they will someday get back to it. So keep the receipts on any basis related information that you have. Let's see. Here's a comment about a question saying that someone was furloughed from work and they terminated in the year 2021. After they left work in 2020, they were paid their vacation pay. Is this going to be a 1099 income? I don't think so. Anything that comes from an employer is going to be wages if the character of the earning of it was wages. So I would expect to see that vacation pay show up on a W-2 with withholding and Social Security attached to it. Let's see. Is the Medicare adjustable premium that we were talking about based on modified from 2 years ago or 1 year prior? Okay, so if you look at what's on the screen right now, in the top of it, it says, if your yearly income in 19 was, so it's 2 years. The confusing part is that 19 return got filed in the year 2020. Okay. And it's going to be used for purposes of what the premium is going to be for the very next year, 21. So, but it's been in the rules for years. This is actually a George Bush 2 provision, and it was never attributed to him. I researched it and attributed it to him because I found out who did this to us. And when it first went into law, it was put in as a way of providing part of our Medicare, the drug benefit with Medicare. That's what got them to put this in as a funding mechanism on it. And at that time, very few people paid it. But what happens is they put these thresholds in, and inflation happens, time passes, income isn't worth as much, and more people get sucked into the fray. So that's part of what's happening with that one. Let's see. And with that, I think we've gotten to the end of the questions. Yeah.
Thank you very much, Claudia.
Thanks for joining us today. Yeah.
One comment, if any of you would like to save the chat questions, just go down in the lower right-hand corner of the chat window. There's 3 little dots next to the smile. Click on it and click save, and it'll save on your local computer. Claudia, thank you very much for a terrific presentation.